Good afternoon. We're going to get started on hour number 7 of our continuing professional education so that we stay on track. Bob Grossman had mentioned earlier in the day that we do a lot of work in the business transaction arena, and that involves a number of different disciplines, our accounting and audit practice, our tax practice, and certainly our business valuation practice. So we wanted to take some time today and talk about business transition for privately held enterprises. Most of our clients are privately held enterprises, and going through a business transition is a very significant event. In fact, it's something that most business owners only do once during the course of their business careers. Our course objectives today, and Mark Wolstoncroft, who's a senior manager in our audit group, will be presenting with me, are to familiarize you with the market and what's going on in the transaction arena, to tell you about our experience in the transaction arena, to cover what CFOs and controllers ought to be doing, because ultimately, every business faces some transition, whether it's within the family or, whether it's to an outside owner or a third party. We're going to talk about private company succession. And then finally, we're going to actually go through a case study. It's an actual deal that we worked on. Of course, the identity of the company has been safeguarded or removed, and we've changed the numbers around a little bit, but it'll give you an idea of how a transition within a family worked, and that's something that we'll touch on some of the concepts that Melissa and Bob mentioned when they talked about business valuation this morning. So first thing I would note is that, deal flow continues. We're seeing a lot of activity in our practice, and we know other practitioners and people that work in this particular arena have been very busy. Why is that? First of all, interest rates continue to be low. As we all know, interest rates have been extremely low now for 8 or 9 years, and those low rates really support these transactions where there is at least some amount of borrowing involved. Returns for investors in bonds and equities are muted, so investors are turning to other alternative investments, including private equity. We see some of our clients that have larger investment portfolios that are putting money into private equity investments, and those alternative investments are representing a bigger and bigger portion of their investment portfolios. And then finally, I would say the continued aging of the baby boomers. There's been talk for years of the transition that's happening from generation to generation. First it was the greatest generation to the baby boom generation, and now we have a transition which is going to take place over the course of the next 10 years with a lot of the baby boomers retiring. So let's look at some statistics relative to how high the activity is. Activity levels in 2014 and 2015 far surpassed the M&A boom in the mid-2000s. Of course, that's many years ago at this point, over 10 years ago. 2015 was the biggest year ever in the M&A market. So there are actually over 12,000 transactions, which was up 7% from the prior year. And the cumulative value of all those transactions was $1.9 trillion in value, which was a 36% increase in comparison to the prior year. What's happening in 2016? That activity continues, and we think it's going to be strong for the remaining couple months of the year. So far through September of 2016, there have been 9,200 deals versus about 9,100 deals in 2015. What's happening from a valuation standpoint? The median enterprise value to EBITDA, that's EV over EBITDA, is basically sitting at around 8.6 in the third quarter of 2016. That's down slightly in comparison to last year, when the multiple was 9.5 times EBITDA. Now, when we're looking at these companies, there's a very wide range of value. The transaction values in the study that we found was from $1 million in transaction value up to $500 million in transaction value. So, this represents an average. I mean, certainly there would be deals that would be larger from an EBITDA multiple standpoint, and there would be others that would be smaller. The EBITDA multiples are going to vary. That's going to depend on the industry. It's going to depend on the size of the business. Generally, what you see happen, it's not going to happen all the time, is that the EBITDA multiple for a company that's smaller and generating a smaller amount of EBITDA is going to be lower than it is for a much larger company. Again, that's just a general rule. So when we're talking about EV or enterprise value, that's before adjusting for cash, debt, and working capital. Deals are generally plus cash and minus debt. And then, again, there's usually a working capital adjustment that comes into play in the transactions that we look at. It makes sense, right? I mean, if you have company A that is doing $8 million of business or is worth $8 million, you have company B that's $8 million in value. If one has debt, the other one does not. The one without the debt is going to be worth more money to the owner, when it's all said and done. So looking at enterprise value in comparison to EBITDA multiples puts all of these transactions basically on a same basis, excuse me. Stated another way, the owner gets the cash in the deals and is responsible for paying any debt that might exist at the company level when the transaction occurs. There are some very big deals in 2016. Here you can see the 5 largest deals. The top one was some Pittsburgh connection. And maybe some of you are lucky enough to own some of these companies that were acquired, but you can see that these deals are very significant deals. And there's a lot of additional information in the handouts that I've provided to you today, which gives you information on some of the larger deals, where the deals are taking place, what PE multiples are like in public company deals, etc. The other thing I want to go over is the composition of the deals. And you look at the sellers. Where the sellers are, you can see divestitures, 3,300 transactions, publicly traded, 400 transactions. Look at privately owned. Privately owned are 7,000, or 59% of the number of transactions that occurred in 2015. And then foreign sellers or foreign transactions represented 1,200 or 11%. So again, I mean, this is really where our practice is focused with these private sellers or private transactions. And most of you in this room are involved with private businesses that at one time or another is basically going to transact and be sold. Here's another interesting thing that I found. I mean, the deal flow for privately held companies back in 2009, when the economy was pretty rocky, you can see there were about 3,500 deals that were done. A lot of companies in that time frame probably were not even marketable, or the owners didn't want to take them to market because revenues were depressed, earnings were depressed. Many of these companies might have been in a loss position. But you can see over the course of this 6-7 year period of time that transaction volume has doubled with the privately held companies, and actually has shown pretty significant growth all the way from that trough year of 2009. So our experience, I want to tell you a little bit about that so that you know what our capabilities are. We have represented corporate buyers. We've represented private equity pretty extensively, which is getting to be a larger and larger part of the buyer pool that's out there. And we've also represented individuals that have bought businesses. But by and large, the first 2 categories, the corporate and the private equity buyers, are the buyers that we're representing. They're also the sellers that we represent. We do sell-side representation as well. The services that we provide, basically fall into the categories that are noted here. We talked last year, for those of you who are here at CPE Day, about diligence services. We get very involved in the diligence side of transactions from a standpoint of looking what's under the hood, and making sure that whoever the buyer is getting what they expected to get when they're executing, or in that period where they're considering the execution of the transaction. And we're making sure that the quality of the earnings is what that buyer expects it to be. A lot of times in privately held companies, there's a lot of noise in the numbers. The noise in the numbers can relate to owner transactions that might discontinue. It can relate to unusual transactions which have occurred in the business and may not be recurring items. And there's a whole host of things which can occur in those numbers that we want to flush out when we're looking at that quality of the earnings stream that the buyer is buying. And essentially that's the biggest part of what the buyer is buying, is that future earnings stream. It's not so much the pool of assets that support the business. We're also very involved in structuring transactions. This is where our tax group gets very involved. We want to make sure that the buyer understands the tax consequences of the transaction and also knows what kind of tax deductions they are going to achieve on a post-acquisition basis. Oftentimes there's an ability to structure the transaction in a way to make the deal less expensive. And then finally, we're involved in implementation or post-acquisition work. So for privately held companies, we can really provide a menu of A to Z services to help that business owner from the time that they decide they're ready to sell all the way up through the date of sale. And if it's a buyer, the opposite side of the equation. The next thing we wanted to go over is sort of preparing for transition, because like I said, every business at some point or another is going to face this kind of a transition. It's either going to be within a family if it's privately held, possibly, or a sale to a third party. So one of the things that Mark is going to do is basically telling you or explaining to you and covering some of the things that you need to be doing as controllers and CFOs of companies in getting ready for that kind of a process, even if it's not imminent. One of the biggest factors that leads to an unsuccessful transition of a business is not taking the time to plan. Just like an unsuccessful retirement is often impacted by not planning and taking the time in advance. So Mark, I'm going to turn it over to you and let you talk about some of the things our CFOs and controllers can do.
All right, thanks, John. Everybody hear me okay?
Yeah.
Very good. Well, John and I have had the opportunity to work on a lot of transactions with a lot of really great controllers and CFOs, both here locally and around the country. Based on those interactions and questions that we commonly get from business owners and sometimes from bankers of business owners, we put together a list of some things that we think controllers and CFOs can be doing in preparation for a future transaction. I don't know about you, but anytime I hear about a list, I can't help but think of David Letterman and The Late Show. So our list is good, but it certainly wouldn't make David Letterman proud. So along the way, I'm going to weave in a second list, and that's a list of, it's a list of the top 5 states I've visited in conjunction with these transactions, based on my travel experiences and based on the quality of their barbecue. All right, so first, I know I'm preaching to the choir here, but maintaining quality GAAP accounting records is the first place to start. And really, it makes the process much, much better. These transactions tend to have more questions and more analysis than most sellers know to expect before the process starts. The less GAAP your financial statements are, the less pleasant the process is likely to be. It's also wise to have monthly reconciliations and analyses of all your significant balance sheet accounts, your reserves, and your allowances. A few of the transactions that I've had the opportunity to work on were very closely held companies that historically took some aggressive tax positions. And that also allowed their GAAP books to become similarly compromised. One business owner routinely purchased excess inventory for every job and expensed it rather than capitalizing it. As you can imagine, it was a process and a challenge to analyze what the actual working capital of the business was and what the EBITDA was during that period. So the transaction would have been much smoother if the records had been kept on a GAAP basis. And I guess the other note I would make here is that, sometimes I think in the general public size anyway, private equity firms can kind of get an aggressive reputation. But what I've found in dealing with a lot of private equity firms is they're really interested in having the accounting records be the actual reflection of the company's earnings, because they know that they're going to buy and then several years later they're going to sell, and they don't want the process to be any harder on the sell side than it is on the buy side. So they really tend to be interested in having good quality GAAP accounting records.
Mark, I was going to say too, just to interject, some of our companies, which as they've approached that point of selling, they've decided to move to an audited set of financial statements. They may be a company that's smaller and maybe only had compiled or reviewed financial statements, but having that audited set of statements really adds into the quality of what a potential buyer is going to look at, and gives them more assurance in terms of the quality of the earnings and the balance sheet as well.
Yeah. So the first stop on our trip around the country is Alabama. I've worked on a number of assignments down in Alabama. I'm going to, my experience there is mixed. The barbecue there is excellent. Dreamland Barbecue, if you ever get a chance to go there, very good. My favorite's probably Jim and Nick's. But don't be in a hurry to get down there. If you're in too much of a hurry, what I found is I-85 is well patrolled by the police officers. And not only can you rack up a nice speeding ticket, but you actually get some new credentials to add to the end of your email tagline. I like to say Mark Wolstoncroft, CPA, super speeder. That's an official designation in the state of Georgia, in case you didn't know. All right, second, improving performance. Obviously, we're all interested in improving performance in our businesses. One thing to keep in mind is, as John mentioned, purchase prices are generally based on multiples of EBITDA. So any improvements that you can make to EBITDA could be worth, on the low side, 4 times, maybe 7 times, maybe even as much as 10 times in a transaction. You could look at this in a couple different ways. First of all, to the extent that you can implement real changes that impact EBITDA, even marginally, the cost of those benefits the cost benefit of doing that may be better leading up to a deal than it ever has been before. Second, you should really be identifying and tracking everything that is non-recurring or that would not be needed under a new owner. And that gets into monitoring EBITDA and pro forma adjustments. We're going to go over an analysis of EBITDA and pro forma adjustments a little bit later in this presentation. But just a real quick example, maybe last year you had to pay $10,000 to settle a small lawsuit with a former employee. That's going to be harming your EBITDA. And if somebody's looking at the deal, they might be looking at EBITDA. If you don't remind them that there was a $10,000 non-recurring item in that year, and you have a 7 times EBITDA multiple, you're going to be missing out on $70,000 of transaction price. So certainly anything that's non-recurring, anything that would be owner lifestyle expenses, things that run through the company now but might not need to run through the company after the transaction, you would want to identify. And then any non-cash charges to the income statement you'd also want to look at, particularly changes to reserves or estimates. And it's best to update that EBITDA analysis regularly. Many of our clients like us to look at an analysis of that annually in conjunction with our audit or our review work. And as I mentioned, we'll look at an example of that shortly. Next is, number 4 is benchmarking. You should definitely get your hands on some industry information. Most of the industry information that is available is reasonably specific to different business operations, and it even carves up revenue size companies. So it might have $0 to $5 million companies, $5 million to $10 million companies, $25 million and up. So you can kind of benchmark yourself, particularly relative to where your EBITDA numbers are compared to your sales numbers, and where your working capital numbers are. You'll want to look at that because buyers are going to be looking at that, and they're probably going to ask you questions about why you differ from your particular industry. Our next stop on the barbecue tour is Missouri. I wasn't in town long for this assignment, and I didn't get to some of the top recommendations. But so subject to further review, I'm going to give Missouri the number 3 spot. The most interesting part of this trip was the rental car experience. And I can't hold this against Missouri, but I went with a coworker that's going to remain nameless at this time. But when we got to the budget rental car counter, they said, "Would you like to drive a stick this week?" Well, this gentleman that I was traveling with, his eyes lit up. Yeah, it's a what was it? A Ford Focus ST 6-speed, and his eyes lit up. And little did I know until after we pulled out of the parking lot that he doesn't drive a stick. So my neck and back are still a little sore. Number 5, control investment and working capital. Transactions usually include a working capital target. That's in order to protect both the buyer and the seller between the time that the purchase price is negotiated and the transaction is closed. It can often take 2 or 3 months to close a transaction. And what you don't want to have happen is you don't want to have working capital deteriorate over that time, and for the buyer to be left really making a bigger investment than they had planned to make. So when you're leading up to a transaction, usually those working capital targets are based on a 12 trailing month average of working capital. So if you allowed working capital to be a little bit higher than it normally would be in any of those months leading up to the transaction, your target's going to be higher than it should be, and you're going to miss out a little bit on the settlement. So you really want to manage the working capital closely, particularly in the 12 months leading up to the transaction. The last item on this slide is capital spending. Certainly, buyers are going to look at historical capital expenditures. They're going to make inquiries around any capital expenditures that have been deferred, and what's expected in the coming years. So now, immediately prior to the transaction probably isn't the right time to make a big investment in something that's not immediately going to impact EBITDA, because you're going to shoulder the cost, but you're not going to really experience the value that's created by that capital expenditure. Next is inventorying important contracts, documents, and agreements. The buyer's team is going to want to see substantially all your contracts and agreements. There will likely be a data room set up where the buyer's team where all those documents will be uploaded, and where the buyer's due diligence team will be able to go and look at those documents. And as you inventory those documents, you should be considering if there's anything that needs to be updated. Maybe your bylaws are very, very old, and they should be updated. Or perhaps there's something that you catch that would be concerning to the buyer relative to your sales contracts or otherwise. I mean, generally any long-term contracts they're going to be pretty interested in, and you want to see if there would be anything problematic in there. All right, our third stop on the barbecue tour is North Carolina. I actually haven't done any work in North Carolina, but my in-laws lived in the Cary, North Carolina area for many years, so I had occasion to sample their barbecue. I'm going to give North Carolina the last place, number 5 spot. And I swear this rating is in no way a reflection of my mother-in-law's cooking. Going through this process is really going to build a base of personal knowledge. Monitoring EBITDA and pro forma EBITDA on a monthly basis is really going to prepare you well to answer the questions that are going to arise during due diligence, and going through the inventorying of the contracts is really going to prepare you to have all the information available. Once you know your numbers and have your contracts agreements in order, some more strategic things to think about. You want to think about whether you're going to sell stock or assets. Buyers generally want to buy assets, and sellers generally want to sell stock. There's really a couple reasons there. When buyers buy assets, they can specify which liabilities they're going to assume. So basically that leaves the seller holding the bag for any liabilities that are known or unknown arising from their ownership period and that weren't assumed by the buyer. Further, buyers like asset deals because they can write up the basis of the assets and deduct such over the ownership period, while the sellers generally want to sell stock in order to achieve capital gains treatment. So knowing the cost, knowing the tax cost of selling assets versus stock can be useful in your negotiations, because they're no doubt going to approach you and say, we'd like to buy assets, and you can say, well, that's fine, I can sell you assets, but that's going to cost me X, so we need to adjust the purchase price. Our 4th stop on the barbecue tour is West Virginia. This one's a little bit tough for me. I love West Virginia. I was born there. My family loves to vacation down in Canaan Valley, West Virginia. The state is beautiful and the people are really great. While I've had some great venison down there, I really haven't been impressed with their barbecue. So we'll give West Virginia number 1 for country roads and number 4 for barbecue. Lastly, 2 last things on this slide. Obviously, you want to start to think about what your pool of buyers might look like. Finding a strategic buyer can lead to higher EBITDA multiples because they're willing to pay both for the financial aspects of the business, but they're also going to achieve some savings as a result of either consolidating expenses or having supply chain control, or taking a competitor out of the market. So certainly to the extent you can identify a strategic buyer, that's great. And also the more financial buyers you can have in the pool, the better the bidding might be. All right, last on the barbecue tour, East Texas. Other than the night I spent sleeping in the George Bush Airport, I love my time in East Texas. We ate at Tony's Barbecue every day for the first week I went down there. Tony's definitely takes first place. Number 12 is determine a realistic expectation. That's really critical to closing a deal. And really the path there is a solid pro forma EBITDA analysis, and some market data regarding EBITDA multiples can also be a big help, and we'll talk about that shortly. And John, I think that we're going to turn it back over to you.
Yeah, so far we've been talking about general parameters and general things related to a business transition. Now we're going to make it a little bit more narrow and talk about the transition of a family business and go into a case study, an actual transaction that we worked on. So family businesses are always quite interesting. And we found some statistical information in regard to family businesses and what the plans are for the owners relative to their family-owned businesses. So you can see that 40% plus plan to pass the business on to the second generation, to their offspring. You can see a much smaller percentage plan to pass on the ownership, but bring on professional management. And then you can see these other alternatives are in a minority, sell or float, don't know, and other. Obviously, some businesses will transition within the family, but it's interesting. An SBA report on small family-owned businesses indicated that 30% make the transition to a second generation, and only 15% are successful in going to a third generation. Why is that? Well, the transfer of a family business not only involves complex financial, tax, and legal issues, but it often raises critical family issues amongst the generation to which the business might be passed. Which family member is going to own the business? Family member or members are going to own the business? What's the value put on that business? And how can an asset transfer essentially be evened out? So, if one person in the second generation or two people in the second generation are going to get the business, and that represents a large part of the wealth of the owner of the company, how does he or she basically equalize, the other children who will not be involved in the business? And those are just some of the considerations. I mean, some of the second generation may work in the business, some may not, etc. So key concerns and statistics, around the intergenerational transfer. Succession failures are generally traced to to poor planning, a lack of communication, and family conflicts. Like everything that turns out well, you have to plan. Oftentimes, there are too many cooks in the kitchen. You can get larger families, especially businesses that have gone to a second or third generation. You can have multiple family members involved in the business. They may have different objectives. Some may want to continue to work in the business and own it. Some may just want out and want the proceeds or their share of the proceeds. The vast majority of families, interestingly, lose their wealth by the second generation. So even though 30% of those businesses pass to a second generation, it doesn't work in that second generation. So you're seeing more and more businesses being sold outside of the family. So next we're going to go on to a case study. This again is something that Mark and I worked on together. And it was a unique assignment. Essentially what we had a 50-year-old plus family business. We'd had 2 generations of ownership. The owner was ready to retire. In fact, the owner waited a little bit too long. I would say the owner got to a point where it was definitely ready. So it sort of cut our planning time a little bit. The owner wanted to preserve the company as a standalone business with continuation of certain programs and initiatives that had been put in place and that were very important. And the nice thing was that the next generation of the family was already involved in the business, some as employees and all of them as board members. The nice thing as well was that there was cohesiveness within the family. The siblings were all very different, which is not unusual. But they got along and they had common goals and objectives, which made this something that was a possibility. So the first step, and it goes back to one of the presentations that was made earlier this morning by Bob and Melissa, involved a gifting of some of the non-voting shares in the company to that second generation. So the owner recognized the readiness to retire, the readiness to move on and to sell the business. And actually, the thought process was that the business was going to, go to an outside buyer. Recognizing that situation, there was an evaluation performed actually by our business valuation group to look at the value of a minority block of shares with non-voting, they were non-voting shares. And also what was taken into consideration was the owner's personal finances. In other words, if they gifted away a certain percentage of the stock, which in this case was 40%, would they have enough remaining after a sale of the business between the proceeds of the sale and what they had already saved to support them in retirement in a manner that they were accustomed to. So that was the first step in the process, and that probably occurred about 13 months before the actual transition of the business within the family occurred. As a result of that, and again, as Bob and Melissa mentioned, there was a portion of the estate exclusion that was used in order to accomplish that. The gift was 40%, and there was discount for minority and non-voting features of the stock, and certainly there were transferability restrictions associated with it as well. From a standpoint of determination of value, initially, as I mentioned, the thought was that this business was going to go to a third party. So there had been discussions with investment bankers, in particular 3 different investment bankers that weighed in terms of what the market for this company might look like and what the EBITDA multiples might be. So we had some benchmarking that was done to give us some sense of what the value of this company might be. And again, it was EBITDA based and using a financial multiple or an EBITDA multiple on that. So Mark, I think at this point I'm going to turn it back to you and have you walk the crowd through how we went through the process. I would mention, as Mark gets into this information, what you see on the screen may be a little bit hard to read. So we would encourage you to look either in your books or on your laptops, relative to Appendix A, which sort of lays out the information that we put together and are sharing with you.
Yeah, thanks, John. So one of the first steps we wanted to talk about is the pro forma EBITDA analysis. And this is, an exercise that we went through with the CFO of the company and reviewed with the owner of the company. And really, it starts with a simple calculation of EBITDA based on the financial statements. The next step was to identify some pro forma EBITDA adjustments that would be applicable to a financial buyer, and then also some pro forma EBITDA adjustments that might be applicable to a strategic buyer. As John mentioned, these next slides, the next 3 slides are from page 1 of Appendix A in your materials. I think you might be able to read some of them might be a little bit small. This one is pretty straightforward. It's simply the calculation of EBITDA. We took net income plus interest. There were no taxes because it was a pass-through entity, not because it was one of Donald Trump's entities. We added back depreciation and also the gain or loss on disposable equipment to come down to EBITDA. This next slide just carries forward the EBITDA per the financial statements to the top, and then we have a number of pro forma adjustments identified to come down to a pro forma EBITDA for a financial buyer. The numbers aren't all that important to see here. It's really kind of the nature of the items that's probably most important to you. But the first items are really owner lifestyle expenses, and those might include country club dues, sporting tickets, personal or family legal expenses, charitable contributions, really anything that was discretionary by the owner and might not be necessary under a new owner. We also added back the board of directors fees that wouldn't be necessary under a new ownership regime. Next, we have some compensation adjustments, and really I've seen those go either way. I remember working on a transaction with some C Corp owners that were pretty aggressive. What they were doing was, in order to get money out of the company, and rather than treating it as a distribution, they were essentially giving themselves very, very large bonuses at the end of the year. And their compensation was higher than the IRS probably would have allowed if the IRS had looked at it. So in that case, those owners, we were representing the buyers, not the sellers, but in that case, those sellers were basically saying, yeah, we knew we took X million dollars out of the company as compensation, but you guys won't need to do that going forward. So they had an additive item to their EBITDA. In this case, there's actually a deductive compensation adjustment, and that's because in this case the owner was taking very little in the way of salary, and they knew that, you know, when a new company came in, a new ownership regime came in, there would need to be a general manager that would pull a significantly higher salary than was being pulled previously. So in this case, there's a deductive compensation adjustment. Next, we have some non-recurring expenses related to equipment that were identified. And then really any changes in reserves that hit the income statement should be considered. Obviously, the buyers would frown upon a situation where you told them you had this much EBITDA, but this much of it is because you reversed a reserve. They would not be happy to find that out. So, you know, you would want to kind of normalize those items in here. And then finally, there are some expenses in different businesses that can be quote unquote lumpy. So maybe your strategy is that you go to a particular large trade show once every 3 years, and there's a significant expense in that year. And maybe in order to present the most economic picture you can, you might want to smooth that and have a normalization adjustment in the EBITDA. So those are some of the types of things that were adjusted to come up with the pro forma EBITDA for a financial buyer. I would just tell you that when you're going through this process, obviously there will be a high degree of scrutiny by a buyer on any of these adjustments. So you want to be prepared to defend those adjustments, have good support that someone else can easily follow, and this probably isn't the best time to take a throw in the kitchen sink approach. The more simple you can keep this, the more easier it will be to agree to. And I guess the last thing I wanted to note on this slide is this is really based on annual EBITDA. And all of these slides are based on annual EBITDA. We took 2012 as the far right column, 2013, 2014, 2015, and then projected 2016. That we were able to do that in this case because we kind of knew what the closing date was going to be, and because, you know, we were dealing with two related parties. But normally you would see this on a 12 trailing month basis, and it would be updated monthly throughout the process. This next slide, again, it's just taking the pro forma EBITDA for the financial buyer from the previous slide and then making some adjustments for a strategic buyer. And this particular seller had some negotiations previously with the strategic buyer, and they knew what some of the things that the strategic buyer would plan to do if they came in. Those were principally around, I guess, positions at the company that would be duplicate positions for the buyer. And so they knew that they would be able to, that the buyer, a strategic buyer, would probably eliminate some of those positions and achieve some savings. When we talked to some investment bankers about these, they said, you know, you probably want to temper your expectations relative to what you would be able to achieve there. And so we reduced those add backs by 50%, recognizing that you'd probably kind of share that. The buyer would get credit for some of it, and, you know, the seller would not be willing to pay for all of it.
I would say too, as Mark is going on to the next point, is the reason that we delineated this information was to let that seller know, even though it was, you know, it ultimately ended up, you know, being transitioned within the family, you know, what was potentially being left on the table. And, you know, were they comfortable with that, knowing that, you know, if a strategic buyer came in, and there were certainly some strategics that were identified, and one that expressed interest, that, that was affecting, what she would probably take out of the situation.
I'm going to try to pick up the pace a little bit here so that we can finish on time. But this next slide is an analysis of potential values that we did. So we're taking the EBITDA, the pro forma EBITDA per the previous slides, and putting it into the first column here. And so we have the top section is for the year ended December 31st, 2015 on a TTM basis. And then at the bottom, we had the average for the years ended December 2014 and 2015. So we took the financial buyer amounts, we took the strategic buyer amounts. We had talked to some investment bankers, and they were really advising that for this company, you could probably look at a 5-time EBITDA multiple on the low end and a 6.25 EBITDA multiple on the high end. So you can see that we've just multiplied the EBITDA amounts by the multiples to get to a calculated enterprise value. And then, and then normally these deals are cash-free, debt-free deals. So you calculate the enterprise value, you add the cash that's on the balance sheet, you subtract the debt that's on the balance sheet. In this case, there was a small discount that was involved that we don't need to get into to get to the calculated equity value. And that's really what somebody might be willing to pay for 100% of this entity. And so basically, the thought process that the family went through was to take the midpoint between the 11,315 up top there for a financial buyer, which was the smallest enterprise value, and the 15,194, which was the highest enterprise value. So they took a midpoint of about 13 for purposes of this example. And next we did a historical net working capital analysis for them. The actual analysis was much more detailed and was on a monthly basis, but we kind of looked at what the average working capital was for 2016, 15, 14, and 13. Since the purchase price was really based on the EBITDA level for 2015, we thought that they agreed that the working capital target should be roughly the average working capital for 2015. And so that average was 2,382, and so they agreed upon a target of $2,300. And then lastly, on deal structure, I told you they picked a $13,000 valuation plus cash minus debt, came down to 10,116. They were purchasing 60%, so the purchase price was a little bit north of $6 million. Of course, there were some transaction costs involved relative to professional fees, and then the purchase price along with the professional fees was paid for. $2 million of it was paid at closing, and then $4,220,000 was paid, also paid at closing, but financed by the buyer. I think this one's you, John.
Yeah, so this is really a unique situation. I mean, normally when we're involved in a transaction and we refer to it, we're either representing the buyer or the seller. In this situation, we were actually, advising the family and basically serving as an intermediary. We were working with legal counsel, and we also worked with the bank in helping to arrange the financing to support the deal. And we've gone through this in about 15 minutes just to show you how a privately held business might be transitioned within a family and how it might be done affordably using a gifting strategy, as well as how we went through the valuation process and getting the deal paid for. This took a good amount of time. It took probably a year of calendar time and a fair amount of professional cost between our firm and the legal team, but it was something that worked out very well and that the family was very happy about. We did also, and are continuing to help, with the business after the transaction was completed. We mentioned before that we do post-implementation work. We're not going to go into that today, But hopefully what we've been able to do is, to give you a better understanding of what's happening in the market in terms of transactions and the values that are being placed on the business. We've educated you on some areas that you can focus on in your day-to-day role as a CFO or controller in helping, your business owner. And we've gone through a case study. And Mark and I would be pleased to talk to anybody afterwards if you have any questions in regard to this particular transaction, how it worked, or some valuation and business issues that you may have with business transactions. So we're going to close off with that. I'd like to thank Mark for pulling this together for today's presentation. And I want to now turn over the program to my partner and friend, Bob Grossman, who really has been the architect of these CPE days. He was very gracious in thanking Mary Lou and Carissa earlier today for all of their legwork, and rightfully so. But the architect of this CPE day is Bob Grossman. So Bob and one of our newly minted managers, Mike Weber, will be taking a humorous look at tax planning. What a great way to end the day. So thank you all for your attention.